Last class we have discussed provisions regarding section 54, 54B, 54 EC, 54 EE. So and 54D as well. So these are the 5 sections we have discussed. Now let us start with a problem on section 54. Okay, so then we can understand the provision clearly. See why I am focusing on section 54, because if you observe, basically the conditions and entire thing of section 54, 54D, 54B, 54 EC, 54 EE all almost the same. That's the reason I am focusing on nearly two problems based on section 54, so which gives you a clear understanding of the concept of the provision what we have discussed in the previous session. Right, now let us see what this problem speaks about. This problem is telling you Sunil entered into an agreement with Mr. Dhaval to sell his residential house located at Navi, Mumbai on 16th August 2019. So the house is in New Mumbai. On 16th August 2019, agreement has entered by Sunil with Dhaval. Sunil entered into an agreement with Dhaval to sell his residential house. Now, for what consideration? 80 lakhs. What is the date of agreement? 16th August 2019 is the date of agreement. Now, sale proceeds were to be paid in the following manner. So how the sale proceeds is being paid? The sale proceeds is being paid in the following fashion: 20% through account pay bank draft on the date of agreement itself. That means on 16th August 2019 itself, 20% is being received. 80 lakhs into 20%, 16 lakhs is received on the date of agreement itself. Balance 60% of the on the date of possession of the property. So on the date of possession, he is going to transfer the 60%. That means 48 lakhs will be transferred on the date of transferring the possession, and balance after completion of registration. So three parts are there: 20% at the date of agreement, 60% at the time of transfer of the possession of the property, balance at the time of completion of registration of the property. So that's what is the basis. Dhaval was handed over the possession on 15th December 2019. That means on 15th December the possession was handed over. So that means on this date the 60% is paid, and the registration process was completed on 14th January 2020. 14 January 2020. So ultimately now the balance of 20% was received on 14 January 2020. He paid the sale proceeds as per the agreement. So 20% was paid on 16th August 2019. 60% was paid on 15th December 2019, and balance is paid on what date? On 14th Jan 2020. The value determined by the stamp duty authority on the date of agreement was 90 lakhs, whereas on the date of registration it is 91 lakh 50,000. We have discussed. Now we need to go back to provision called as section 50C. What section 50 says? Whenever you are having two stamp values, one stamp value on the date of registration, another stamp value on the day, on the first stamp value on the date of agreement, another stamp value on the date of registration, then the act says the stamp duty value on the date of entering into the agreement has to be considered on the date of entering into agreement, which is 90 lakhs, provided at least the entire money or part of the money is received through account pay check, through account pay draft, through NEFT, through whatever mode it is, any other prescribed mode of electronic clearance scheme. If you are receiving the entire money or a part of the money, then whatever stamp duty value existing on the date of agreement will be considered as a full value of consideration. Then first of all, let us check whether 50C is applicable or not. Consideration is 80, stamp duty value is 90. So whenever the sale consideration is less than the stamp duty value, 50C is applicable. So what section 50C says? 50C says that stamp duty value or the consideration, whichever is highest. So stamp duty value is 90 lakhs. So my full value of consideration is going to be 90 lakhs. That's it. That gives you full value of consideration. Then what? Mr. Sunil has acquired the property on 1st April 2001. So the property date of acquisition of the property is 2001. Why he is giving? To identify whether it is a long-term capital asset or whether it is a short-term capital asset. For this, I need to see the period of holding. Any land and building or land or building period of holding is greater than or equal to 24 months, the asset is said to be called as long term. So in this case, the asset was acquired on what date? 1st April 2001. So, and that has been transferred, agreement entered, and the transfer was registered on 14 January 2020. So more than 24 months. As it is a period of holding is more than 24 months, I will call this as a long-term cap asset. So I will take the cost of acquisition. What is the cost of acquisition? 20 lakhs. As it is a 20 lakhs, what I need to do? Indexation. I need to provide the indexation. After recovering the sale proceeds from Mr. Dhaval, he purchased another residential house property. Now section 54. What section 54 says? You are transferring a long-term capital asset which is a residential house property. Then if you acquire or construct another residential house property within the set time limit. What is the time limit? Here he has purchased. What is the time limit for purchase? The time limit for purchase, either you can purchase 1 year before date of transfer, or you can purchase within expiry of 2 years from the date of transfer, or you can construct within a period of 3 years from the date of transfer. So that's what is nothing but the time limit. Okay, now here what he is doing? Purchased another residential house property for 32 lakhs. As date is not given, I am of the assumption that in the same previous year 1920 itself, another house was purchased. So as what is the cost of the house? 32 lakhs. So 32 lakhs or capital gains, whichever is least, can be taken as deduction, provided the house should not be sold for a period of 3 years. Now, okay, indexation cost is given. So here one point I want to again make you recollect. The amendment as per the Finance Act 2019 clearly specifies that if the capital gains is less than 2 crores, then the SSC will be provided with an option to purchase 2 houses. He will be provided with an option to purchase 2 houses. He can purchase 2 houses, but this option of purchasing 2 houses can be exercised only once in a lifetime. So in this case, as Mr. Sunil has purchased only one property, so we can't do anything for the rest of the property. He can take whatever property has purchased, that can be taken as deduction. Now, let us start with this. So here, compute the income under the head capital gains for the assessment year 2021. So let us quickly start with this problem now. It's basically very simple. Solution to problem number 1. Solution to problem number 1. Now, what is this? Computation of capital gain for Mr. Sunil for the assessment year. Computation of capital gain of Mr. Sunil for the assessment year 2021. Let us see. Now, let us prepare a small table here, which is nothing but your particulars. Then what? Amount in rupees. That's what is the basic thing. Now, the first one, we need to consider something called as our full value of consideration. This, you simply show this as a part of your working note number 1. So in the working note number 1, you show the 50C, applicability of 50C. There are 2 dates which are given. Then why you are selecting 90,000? Why not why you are selecting 90 lakhs? Why not 90 lakhs, 91 lakhs, 50,000? This entire thing we should explain as a part of your working note number 1. So as already we have discussed, I am directly updating here to be what? 90 lakhs. So I am directly updating here the value to be 90 lakhs. We will again discuss when we are writing the working note number 1. So 90 lakhs is nothing but the full value of consideration. Now what? We have identified that to be a long-term capital asset. As it is a long-term capital asset, what I'm supposed to do? I need to provide something called as indexed cost of acquisition. I need to calculate something called as indexed cost of acquisition. How do we calculate that? It's nothing but take your actual cost of acquisition. When the property is purchased on 1st April 2001. If the property was purchased before 1st April 2001, then what the provision says? Cost of acquisition or fair market value on date of 1st April 2001, whichever is higher. So in this case, property was purchased on the date. So directly I will take the cost of acquisition to be 20 lakhs. Cost of acquisition into index value for the year of transfer. The property was transferred in the year 1920. So for 1920, what was your index value? Your index value was 289. So I need to multiply this with 289 divided by index value for the year of acquisition. The asset was acquired in 2001, 2002. So for the index value for the year 2001 and 2002 is what? 100. So this gives you something called as your indexed cost of acquisition. Now 20 lakhs into 289 divided by 100, how much will be getting? I'll be getting 57 lakhs 80,000. 57 lakhs 80,000 will be the indexed cost of acquisition. 57 lakhs 80,000 will be the indexed cost of acquisition. So in this case, we don't have any sort of improvement. Then what we'll do? We will go this difference. I need to compute this difference. What is this difference called as? This difference is called as our long-term capital gain. This difference is called as our long-term capital gain. Compute that. 90 lakhs minus 57 lakhs 80,000. If I do, I'll be getting something called as 32 lakhs 20,000. 32 lakhs 20,000 will be the answer. 32 lakhs 20,000. Now I need to provide what? Less section 54, exemption under section 54. I need to clearly mention exemption under section 54. Now what is the cost of the house? The cost of the house was 32 lakhs. Now what section 34 says? Cost of acquisition of the new house or long-term capital gain, whichever is least. Long-term capital gain is 32 lakhs 20,000. Cost of the new house is going to be 32 lakhs. 32 lakhs. So ultimately 32 lakhs is going to be your exemption. So the difference is what? The difference is going to be 20,000, which is something called as your taxable. Something called as your taxable long-term capital gain. So now you explain, we need to explain this as a part of your working note number 1. We should also explain this as a part of your working note number 2. Why you are giving section 54? Provisions of section 54 you need to clearly mention. Then only you can get this for full marks. So this question, this sort of question maybe ask for 5 marks. Maybe ask for 5 marks. If you want a complete 5 marks, then you need to be answering it in a totality. This is not done. So now we need to open up something called as our working notes. Working notes is one of the most important. So working notes. Working note number 1. What? You need to mention section 50C. If you don't remember the section number, you don't write. As per the relevant provisions of Income Tax Act 1961, that would be more sufficient. But if you write a wrong section number, then you will be losing the complete marks for this. You write the section number only if you are thoroughly and you are confident regarding the section number. Now, section 50C. What section 50 says? See, don't write the entire section because time is very key factor. You just make a point. When section 50C is applicable? When it is applicable? When sale consideration received is less than stamp duty value. Sale consideration received is less than stamp duty value determined for the stamp duty. Then when sale consideration is less than stamp duty value, section 50C is applicable. One point is done. Then what is the consequence of section 50C? Now, what is the consequence of section 50C? As a consequence, stamp duty value will be considered, as full value of consideration. So now you are going to consider the stamp duty value as the full value of consideration. Now in this present case, you are having two stamp duties. One is nothing but your 90 lakhs, another is nothing but your 90 lakhs, 91 lakhs 50,000. So two stamp duties are there. Of the two stamp duties, why you are considering only 90 lakhs, that I need to explain. That point we need to explain. If in case of change in stamp duty value, stamp duty value on date of agreement, and on the date of agreement, in case of change in stamp duty value on the date of agreement and date of registration, what the act says, value on date of agreement has to be considered. So I will be considering stamp duty value on the date of agreement, provided what? If entire consideration or entire consideration or part of consideration is received, entire consideration or part of consideration is received in account payee check or draft, or it could be something called as ECS or any other prescribed mode, when on date of agreement. So on the date of agreement itself, if you receive a part of the money or entire money in a account pay check or account pay draft or ECS on the date of agreement, then whatever agreement value existing on the date of agreement will be considered. So in the present case, what? In the present given circumstances, what is happening? In the present given circumstances, 20% of consideration was paid through account payee draft. 20% of the consideration was paid through account payee draft on date of agreement. Hence, stamp duty value on date of agreement has to be considered for section 50C. Done. Now second working note, you just explain, I will just mention what points you need to write. Exemption under section 54, you just need to mention conditions. What? Transfer of long-term capital asset and acquire another transfer of long-term capital asset, which is nothing but a residential house property, and acquire another residential house property, and you write down the conditions. What is the conditions there? Time limit, you need to update regarding the time limit. So what is the time limit? You can either purchase 1 year before or within expiry of 2 years you can purchase. In case of construction, within expiry of 3 years from the date of transfer, you need to do. And lock-in period, you should not dispose of the property within a period of 3 years. If you do that, whatever gain exempted earlier will be taxable. That we'll see. That in the next problem or subsequent problem we'll try to see. If the property is sold within a period, then how do I calculate the capital gain? That we'll see with a problem. So that's what are the conditions. So in this you should also mention something called as amount of exemption. Something called as amount of exemption. So what is the amount of exemption? You need to mention cost of new house or capital gain, whichever is least is the amount of exemption. So this I want you to write it. So that's what is something called as end of your problem number 1. Now let us quickly go through problem number 2 and see what problem number 2 is speaking about, right? Now let us see here. Mr. Roy owned a residential house in Noida. It was acquired on 9th September 2009 for 30 lakhs. So the date is what? 2009. The cost of acquisition is what? 30 lakhs. Now he sold it for 1 crore 57 lakhs on 17th January 2016. So date of acquisition is 2009. Property is sold in the financial year 15-16. Property was acquired in 9-10. Sold in 15-16. So ultimately more than 24 months, greater than or equal to 24 months. So hence I will call this residential house to be something called as a long-term capital asset. So it's a long-term capital asset which we need to consider. Now Roy utilized the sale proceeds of the above property to acquire a residential house in Panchakula for 2 crores 5 lakhs. So here what is happening? He is selling the house for 1 crore 57 lakhs, acquired another house for a consideration of 2 crores 5 lakhs. When Mr. Roy utilized the proceeds of the above property to acquire a residential house in Panchakula on 20th July 2016. So 20th July 2016 a new property was acquired. This should not be sold within a period of 3 years. Now let us see what is happening. The said house property was sold on 31st May 2019. See, when 3 years period will expire? 3 years period is going to expire on 19th July 2019. So this is the expiry period of 3 years. He should not sell within this period. But when he sold that on 31st May 2019. If that fellow could have waited for 1 month and 19 days, then ultimately that could have been considered as a long-term capital asset and he could have taken some sort of indexation. He had been hurried by 1 month and 19 days, some odd days. So ultimately this if he had waited for this 1 month and 19 days, whatever gains which was exempted earlier could not have been taxable. Now due to this hurriness, what happened? Whatever gain exempted earlier, now all the same thing is going to be taxable, right? Now let us try to see what is the other part which is giving. And he purchased another residential house in Delhi for 2 crores 57 lakhs on 2nd March 2020. The property at Panchakula was sold for 3 crores 25 lakhs. So here what is happening? Here in Panchakula, I had purchased the property for 2 crores 5 lakhs. The same property he was selling for 3 crores 25 lakhs. Now the capital gains is exceeding 2 crores. Okay. Now we don't have the option. You need to buy only one house. Now calculate the capital gains for the assessment year 16-17, 20-21. It's basically a small thing. All working should be a forming part of your answer. Cost of indexation. Index values for various years are as follows. Various years index values given. Now even this is basically a simple problem. Let us try to first start with the assessment year 16-17. Now let us put a heading. Computation of capital gain of Mr. Roy. Capital gains of Mr. Roy for the assessment year 16-17 is as follows. Once this 16-17 is done, then we'll try to do the 20-21. That we'll see at a later stage. Now 16-17. What happened in 16-17? Sold. There is no stamp duty value given. So ultimately I need not apply section 50C. Whatever consideration you receive, I will call that as full value of consideration. What is the consideration received? 1 crore 57 lakhs was the consideration received. So consider this as 1 crore 57 lakhs. 1 crore 57 lakhs. You take this as particulars, you take this as amount in rupees. Amount in rupees. Now, there is no selling expenses given. Less, I need to consider something called as indexed cost of acquisition. What was the cost of acquisition? Why index cost of acquisition? Because the period of holding is clearly greater than 24 months. So now indexed cost of acquisition. So how do I do this? Let us see. For calculation of my indexed cost of acquisition, I want cost of acquisition. What is the cost of acquisition? 30 lakhs is nothing but my cost of acquisition into 30 lakhs into index value for the year of transfer. Index value for the year of transfer. He is transferring that in 7th January 2016. That means the financial year is nothing but 15-16. For 15-16, what is the index value? 254 is nothing but the index value. So into 254 divided by index value for the year of acquisition. This person has acquired that in September 2009. That means 910. So what is the index value for 910? For 910, the index value is going to be 148. So 30 lakhs into 254 divided by 148 is going to give you something called as the indexed cost of acquisition. Now, what is the indexed cost of acquisition you are getting? Let us see. 30 lakhs into 254, 30 lakhs into 254 divided by 148, you will be getting 51 lakhs 48,649. 51 lakhs 48,649 is the indexed cost of acquisition. Now, this difference, we will term that to be something called as our long-term capital gain. So now 1 crore 57 lakhs minus 51 lakhs 48,649, how much you are getting? You are getting something called as 1 crore 5 lakhs 51,351. 1 crore 5 lakhs 51,351 is nothing but your long-term capital gain. Now what this person has done? Mr. Roy utilized the sale proceeds to acquire a house in Panchakula for 2 crores 5 lakhs. Now, long-term residential house property is sold, another residential house property is acquired within a period of what? When? On 20th July 2016, this person has acquired. This property was acquired before filing of the income tax return. See, for the previous year 15-16, when you are supposed to file the return? 31st July 2000, what is it here? 2000. For the previous year 15-16, you need to file the return by 31st July 2016. So, if you are acquiring a property on or before 31st July 2016, or you are depositing the money in the capital gain deposit account, you can take this as deduction. So here, when the asset was purchased, 20th July 2016, before this date. So you can take this as deduction. So lesser, not deduction, exemption. Exemption under section 54. Exemption under section 54. So what is the amount of exemption under section 54? Capital gain or cost of asset, whichever is less. What is the cost of the asset? 2 crores 5 lakhs. What is the capital gain? 1 crore 5 lakhs 51,351. What is least? 1 crore 5 lakhs 51,351 is the least. So ultimately what will happen here? Taxable long-term capital gain is 0. Taxable long-term capital gain is 0. That's what is nothing but for the assessment year 16-17. Now let us see what will happen for the assessment year let us see what will happen for the assessment year 2021. Now let us open another statement. Computation of capital gain. Computation of capital gain of Mr. Roy for assessment year 2021 is as follows. Particulars. Here comes amount in rupees. Now what this fellow is doing here? Let us see. Now we had covered with the first part of the problem. Now let us read the second part of the problem. Now here what is mentioning? The said house property. What is the said house property? The house property in Panchakula. The said house property was sold on 31st May. The said house property was sold on 31st May, and he purchased another residential house property in Delhi for 2 crores 57 lakhs. The property was sold for 3 crores 25 lakhs. That means what is the sale consideration? I mean, what is the full value of consideration? Full value of consideration is nothing but 3 crores 25 lakhs. 3 crores 25 lakhs is nothing but the full value of consideration. Now, less indexed cost of acquisition or cost of acquisition. Let us see. When this property was acquired, the said property was sold on 31st May 2019. Okay, this property was acquired on 20th July 2016. 20th July 2016 the property was acquired. The same property was sold on 31st May 2019. The same property was sold on 31st May 2019. Period is greater than or equal to 24 months. So either is greater than or equal to 24 months, it's a long-term capital asset, and you need to provide something called as indexation. For providing indexation, I need to take the cost of acquisition. What is the cost of acquisition for the house in Panchakula? The house in Panchakula, the cost of acquisition is going to be 2 crores 5 lakhs. The cost of acquisition is what? It is going to be 2 crores 5 lakhs. Now, let us come here. The most important point lies here. The cost of acquisition is going to be 2 crores 5 lakhs. Now, from this, what I am supposed to do? Violated. You should not sell that within a period of 3 years. The date of purchase is 20th July 2016. Date of sale is what? The date of sale is nothing but, see, okay, the date of sale of this property, the said property was sold on, okay, now, okay, this date is wrong. So the said property was sold on what date? The said property was sold on 31st May 2019. The said property was sold on 31st May 2019. If that fellow has waited, say here, if I try to consider the period of 3 years, when the period of 3 years will expire, let us see. Now, let us again go through the provision part here. Okay, see, what the provision says? The property should not be transferred within a period of 3 years from the date of transfer. What is the date of transfer? If you see, the property was sold on 7th January 2016. Now, let us see. Okay, that is the date of transfer of the property. What was the date of acquisition of the property? Roy utilized the sale proceeds to acquire a house in Panchakula on 20th July 2016. So this is nothing but the date of acquisition. You are acquiring that on 20th July 2016, date of acquisition. Now what the act says here, you should not transfer that within a period of 3 years from the date of transfer. So I should not transfer that before 19th July 2019. So I should not transfer that within this said period. If I violate this, what will happen? If I violate this, ultimately the capital gain exempted earlier becomes taxable. When this property was sold on 31st May 2019. You are selling this on 31st May 2019. The property is sold. Now you are selling within this date. If that person could have waited for June and 19 days in the month of July, the gains exempted earlier could not have become taxable. Now whatever gain exempted earlier, what was the gain exempted earlier? 1 crore 5 lakhs 51,351. Now this entire 1 crore 5 lakhs 51,351 will become taxable. Now, means what? Means taxable means that has to be reduced from your cost of acquisition. 1 crore 5 lakhs 51,351. 1 crore 5 lakhs 51,351 is nothing but this. This into what? into the index value for the year of transfer. Index value for the year of transfer. When the property was sold on 19. So I need to consider the index value for the year 1920. So 1920, what is the index value? 1920, the index value is going to be 289 divided by, what is the index value for the year of acquisition? When he has acquired, the said building was acquired, the date of acquisition we had considered here, 20th July 2016, that means 1617. What is the index value for 1617? 264. So I will consider 289 divided by 264. Now let us see what is the value which you are getting there. So here, yeah, 2 crores 5 lakhs, okay, 2 crores 5 lakhs is nothing but the cost, minus 1 crore 5 lakhs 51,000 351. If I consider, that will be taken as my cost of acquisition. That means here I need to consider 99 lakhs 48,649 to be my cost of acquisition. 99 lakhs 48,649 into 289 divided by 264 is going to give you 1 crore 8 lakhs 90,756. Now this difference will give you something called as our long-term capital gain. Now 3 crores 25 lakhs minus this is going to give you 2 crores 16 lakhs 9,244. Now after selling this, what he has done? Purchased another residential house in Delhi for 2 crores 57 lakhs. He has purchased another house in Delhi for 2 crores 57 lakhs. Now even for this he can take section 54 exemption. What is the cost of acquisition? 2 crores 50 lakhs. Now what is exemption under section 54 says? Capital gain or cost of acquisition, whichever is least. So here capital gain is least, so I will be considering 2 crores 16 lakhs 244. 2 crores 16 lakhs 9,244 will be the value. So ultimately my taxable capital gain is going to be 0. So my taxable long-term capital gains is going to be 0. That's what is nothing but your end of problem number 2. But I want you to write with the notes. I want you to clearly mention the notes. Here, conditions for claiming section 54. Here, violation of section 54. So this you need to mention as a working note. Here, you need to mention clearly violation of section 54. That means what? Lock-in period is violated. Whatever capital gains exempted earlier will become taxable. So that capital gain should be reduced from the cost of acquisition. This entire thing you need to explain clearly as a part of your working note. Then only you will be getting a complete marks. Okay. So this problem can be given for 6 marks or 5 marks or whatever it is. If you mention all these things, then only expect a complete amount of full marks. Otherwise, don't expect. Then let us move on to problem number 3, which is based upon 54 EC. So even this we have discussed. So now let us quickly close some sort of problem under section 54 EC. Now 54 EC. Let us quickly see. X transfers the long-term capital asset. X transfers long-term capital asset. What capital asset he is transferring? He is transferring land and he is transferring something called as building. Now what the provision says, if you go back, when 54 EC is applicable, whenever any person transfers a long-term capital asset being a land or being a building, that may be used for what? That may be depreciable asset. If that is a depreciable asset, the period of holding should be compulsory. What? The period of holding should be greater than 36 months. If that is a depreciable, that means if you are using the asset for your business purpose, I can say the period of holding should be greater than 36 months. Now let us see what is happening here. Okay, so here date of acquisition is not given, as it is mentioned as clearly long-term capital asset. I am assuming the period of holding for this commercial house is going to be greater than 36 months. That's it. Now let us get to the problem. Let us get to the solution here. Now first let us discuss the problem, then we'll get back to the solution. Now what is telling? Transfer of capital asset, the date of transfer is given, full value of consideration is given, indexed cost of acquisition is given, it's purely jackpot. Even you need not do the calculation, directly you can apply and directly you can close that particular thing. Now, so here, yeah, so then what? Indexed cost of acquisition is given, investment in specified bonds, National Highway Authority, Rural Electrification Corporation bond, date of investment. This date of investment is very, very important. Why? Because you need to deposit that within a period of 6 months from the date of transfer. Date of transfer is given. So within 6 months, if I deposit, then only I can take that as deduction. Otherwise, I should not take that as deduction. And what is the total amount of deposit? The total amount of deposit is going to be 80 lakhs. But what the provision says? Restricted. I will limit this to, I will restrict this to 50 lakhs. You can take only 50 lakhs as a part of your deduction. Now, is it less than 6 months? Let us see. 3rd April 2019 is the date of transfer. April, May, June, July, August, September. So, within a period of 6 months. So, the first you are acquiring within a period of 6 months. Second, the property was sold on 5th November and you are acquiring the specified bonds on 1st April. So, November, December, January, February, March, April. So even this is also done within a period of 6 months, so eligible, but the total will be restricted to 50 lakhs. Now let us see the solution for this part. Okay, solution to problem number 3. Solution to problem number 3. Now 2 assets are there. What we'll do, let us prepare a small table here. Okay, long term. Okay, let us see full value of consideration. Full value of consideration. 2 assets are there. What? Land, and next one something called as commercial house. Commercial house. What is the consideration received there? 95 lakhs. Okay, rupees in lakhs. 95 lakhs, and this comes something called as 65 lakhs. Now what is this total you are getting? This total is something called as 95 plus 65. Let us see what is the total you are getting there. 95 plus 65, that gives you a total of 160 lakhs. So the full value of consideration being 150 lakhs. Now less what? Indexed cost of acquisition. Indexed cost of acquisition. What is the indexed cost of acquisition? 40 lakhs plus 20 lakhs, total put together 60 lakhs is nothing but the indexed cost of acquisition. Now this difference will give you something called as long-term capital gain. What is your long-term capital gain? 160 minus 60, that you are getting it as 100 lakhs. Again, rupees in lakhs. So you are getting something called as 100 lakhs. So long-term capital gain will be 100 lakhs. Done. Then less exemption under section 54 EC. What is that? 40 lakhs plus 40 lakhs, total put together 80 lakhs. Total put together is coming to 80 lakhs. But what the act says? Restrict. I need to restrict this to 50 lakhs. So now what is my taxable capital gains there? Taxable capital gains is nothing but 50 lakhs. So taxable capital gain is going to be 50 lakhs. That's what is nothing but your solution to problem number 3. Now let us also look into something called as your problem number 4. Yeah, let us see what is your problem number 4. Okay, then we'll discuss something called as, once this problem number 4 is done, we'll discuss something called as section 54. Okay, then in the subsequent class, so once we discuss section 54, we will discuss 111A, and we'll discuss something called as 112, and we'll discuss something called as 112A, and something called as relief. So if I done with this 5 topics, 54F, 111A, 112, 112A, and the relief for 111A and 112 Then ultimately the entire provisions of capital gains is set to be completed. Then we'll do few good problems we'll try to see. At least 5 problems on the complete covering the provisions of capital gains. With that I can say that capital gains is complete in total. So we are now at the ending stage. Only 5 sections are there. We know it's a big ocean. Capital gains, we are having a several sort of sections from section 45 till section 55. So these are the huge sections we are having. Okay. Now let us see the problem number 4. Mr. Selvan acquired a residential house. Mr. Selvan acquired a residential house in January 2002 for rupees 10 lakhs. A residential house was acquired in January 2002 for 10 lakhs. Now what he has done? And made some sort of improvement by additional construction of the house, incurring an expenditure of 2 lakhs. So it's, what is this called as? This is nothing but your cost of improvement. So I can say simply cost of improvement is this. When he has incurred? October 2004. If this is a long-term asset, I need to provide the indexed cost of acquisition. I should also provide something called as indexed cost of improvement. He sold the house in October 2019. Acquired in 2002, sold that in October 2019. So ultimately period of holding is greater than 24 months. Ultimately, I will call this as a long-term capital asset. Now, sold the house property for 75 lakhs. The value of the property adopted by stamp duty valuation is going to be 80 lakhs. Then what the 50C says? Consideration received whenever it is less than the stamp duty value, the stamp duty value will be considered as the full value of consideration. So consideration received is what? The consideration received is going to be something called as consideration received is going to be 75 lakhs. Okay, consideration received is going to be 75 lakhs and what? Consideration received is going to be 75 lakhs. Stamp duty valuation is going to be 80 lakhs. Now basically applied, 50C is applied, but one more point is there. Take your sale consideration. What is your sale consideration? The sale consideration is going to be something called as 75 lakhs. The sale consideration is going to be 75 lakhs. Now take the 5% on your sale consideration. See, 75 lakhs into 5% if I do, I'll be getting 3,75,000. 3,75,000. Now, what is the total? The total you are getting 78,75,000 is the total. So here in this case, what is happening there? The value of the stamp duty, determined is what? The value of the stamp duty determined is going to be 80 lakhs. Okay. The value of the stamp duty determined is going to be 80 lakhs. Now listen carefully. Okay, so now what happened? 105%. So ultimately what I can call this as 105% of your sale consideration is 78,75,000. Now value determined by stamp duty is going to be 80 lakhs. Now what I will do? I will compare value determined by stamp duty with 105% of my sale consideration. Again, value of the stamp duty is 80 lakhs. This 80 lakhs I will compare with 105% of my sale consideration. What is 105% of sale consideration? 78,75,000. Now what I will see? If this stamp duty value is less than, if the stamp duty value is less than 105%, then section 50C is not applicable. Then section 50C is not applicable. Already we have covered few examples when we are discussing this. So again, I am just repeating for your revision part. So here what happens? Whenever the consideration, value of stamp duty is less than 105% of your sale consideration, then 50C is not applicable. But here, value of the stamp duty is 80 lakhs. 105% is going to be 78,75,000. Exceeded. So as it is exceeding, I will apply section 50C. As you are applying section 50C, stamp duty value has to be considered as your full value of consideration. This entire thing you need to explain in your working note. You need to show this as a part of your working note. You need to calculate 105% of your sale consideration. Compare that 105% with the stamp duty value. If stamp duty value is less than 105% of sale consideration, then you are not going to apply section 50C. If stamp duty value is greater than 105% of the consideration, then you are going to apply the section 50C. Now, that's what is the interpretation for that. He had deposited, he had, he has acquired a residential house in January 2019. When the property was sold, he sold the house property in October 2019, and in January 2019 he has acquired a property. So residential house property, long-term residential house property is sold and another property is purchased, so he can take 54 section 54 exemption. Then he had deposited 20 lakhs in capital gain bond issued by National Highway Authority of India in June 2020. What is the date of transfer? Sold the property in October 2019. Sold the property in October 2019. If he purchased that within a period of 6 months from the date of transfer, he can take that as exemption. What is the date of transfer? The date of transfer sold in October 2019. So it is sold in October 2019. What is 6 months? October, November, December, January, February, March. If he is purchasing these bonds within the month of March, he could have taken this amount as 20 lakhs as deduction, exemption under section 54 EC. But as the 6 months period expired, he cannot take that as deduction. What would be the consequences and in which assessment year it would be taxable? If the house property is acquired in 2019, if the house property acquired in 2019 is sold for 40 lakhs in December 2020. What is telling? You are acquiring a property and taking an exemption under section 54, and the same property you want to sell that in December 2020, then what the provision says? Whatever capital gains exempted earlier is going to become taxable. Now let us see what is the capital gain which is going to be exempted, then we can answer that particular portion. Now, computation of capital gain for assessment year, 2021 is as follows. Now what I have to consider? Full value of consideration I have to consider. Amount in rupees. Take that as 80 lakhs, but you need to clearly mention in your notes why you are considering 80 lakhs. What you need to mention? My sale consideration 105 stamp duty value is greater than 105% of the full value of consideration. Stamp duty value is greater than 105% of the full value of consideration. So hence, as per section 50C, stamp duty value has to be considered as the full value of consideration. If stamp duty value is less than 105% of the consideration, then 50C could not have been applied. That's what is the notes which you need to write. I want you to write the notes there. So that's what is something called as the full value of consideration. Then what? Less something called as indexed cost of acquisition. What is the cost of acquisition for that? 10 lakhs was the cost of acquisition. 10 lakhs into index value for the year of transfer. What is the year of transfer? 289 is the index value for the year of transfer. When this property was acquired? In January 2002. That means in the financial year 1-2 the property was acquired. So ultimately divided by 100. This gives you something called as the indexed cost of acquisition. So what is the value you are getting there? You are getting 28 lakhs 90,000 is nothing but the indexed cost of acquisition. Then what we'll do? Then less what? Less indexed cost of improvement. He has incurred some sort of improvement expenses. What is the improvement expenses? Incurring 2 lakhs. So improvement expenses was incurred to be 2 lakhs. In which year the improvement expenses incurred? Let us see. 2 lakhs in October 2004. That means I need to see the index value for 4.3. So what is the index value for 4.3? 113. So now let us say into index value for the year of transfer 289 divided by index value for that year is going to be 113. Now this gives you what? 2 lakhs into 289 divided by 113, that will give you 5,11,504. Now I need to reduce my cost of acquisition. I need to reduce something called as my cost of improvement. Of course, better what you do, you take this in the inner column and you take the total to the outer column. Now you entirely take these totals to the outer column. So here rupees 80 lakhs. So sorry, full value of consideration is going to be 80 lakhs. My full value of consideration being 80 lakhs. Now do the total of your improvement, do the total of your indexed cost of equation and improvement, take the total to the outer column. Now let us write it again. So what was that there? 28 lakhs 90,000 was the total. Then you are having something called as 5 lakhs 11,504 is the improvement. Then the total comes to 34 lakhs 1,504 is your total. So now sale consideration was 80 lakhs. Sale consideration was 80. Improvement plus your indexed cost of equation plus improvement is coming to this. The difference is going to be something called as my long-term capital gain. So 80 lakhs minus this, I'll be getting 45 lakhs 98,496 is the long-term capital gains. From this, I need to reduce something called as section 54 exemption. Exemption under section 54. Exemption under section 54. Now, what is the cost? Acquired a residential house property in January for 25 lakhs. So, I can take this as reduction 25 lakhs. Within a period of 1 year, within a period of 2 years, the house property is acquired. So, I can take that as reduction. Provided with the condition that this property should not be sold within a period of 3 years. Now, after reducing this will be something called as taxable long-term capital gain. This will be something called as taxable long-term capital gain. So now 45 lakhs minus this. Here I cannot take section 54 EC. So now even I need to write that. We need to clearly mention why you are not taking section 54 EC. Why? Because you are purchasing that after expiry of 6 months. So less exemption under section 54 EC nil, because you are purchasing that after a period of 6 months, so you are not eligible to take that. Now this difference is going to give you something called as our long-term capital gain. So what is this taxable long-term capital gain? So what is the difference there? The difference will be 20 lakhs 98,496 will be the taxable long-term capital gain. You need to explain regarding your working note number 1, and this is nothing but your working note number 2. These two things you need to clearly explain. Now what is telling you? He is asking you if this property was sold in December 20. Now December 20 you are selling. First of all, you see whether it is an long term or short term. Period of holding should be greater than or equal to 24 months. When this property was held, October 2019 the property was held, transferring the property in December 2020. So less than 24 months. So ultimately it is something called as a short-term capital gain. Now even that also I need to calculate. If transferred within 3 years, if transferred within a period of 3 years, then capital gains will be as follows. Now full value of consideration, at what price he is transferring? Is mentioned that 40 lakhs. So full value of consideration there is going to be something called as 40 lakhs. Now what will be my, I can't take the indexed cost of equation because this is a short-term capital asset. What is the cost of equation? Now the provision clearly says, as you had violated the gain exempted earlier, whatever gain exempted earlier will become taxable. So the gain exempted earlier becomes taxable. What was the gain exempted earlier? 25 lakhs. The gain exempted earlier is nothing but 25 lakhs. Now this 25 lakhs I should reduce from this cost of equation. What was the cost of equation? Purchase a residential house for 25 lakhs. The cost of equation is 25 lakhs. So take the cost of equation as 25. Now what will happen? I will consider my cost of equation as 0, nil. My cost of equation is to be considered as nil. Now what happens? Now your full value of consideration minus cost of equation, the difference is going to give you something called as capital gain. What capital gain is this? Short-term capital gain. Why? Because you had violated the provision. You had violated the provision. That's the reason you will be considering this as a short-term capital gain. That's it. So that's what is the application of section 54, 54 EC we had discussed. 54 EC and 54D both are same. Only one thing is what? Here under 54 EC, you need to purchase the bonds of National Highway Authority, Rural Electrification Corporation. There you are going to purchase the units which are approved by the government of India. That's what is something called as section 54 EE. Now only we are left with what? Section 54, 112, 111A, 112A and relief. So these 5 sections I can wind up the capital gains. Then we will discuss few problems on the capital gains. So maybe in next class we'll be covering this entire 5 provisions. We'll be trying to finish off the 5 provisions in the coming next class, right? So catch you up in the next class. Any doubts, you just ping me up.